Number one, we're not upside down. And number two, our momentum is only building, which means the efficiencies should only improve.
So one of the things that we see sometimes is investors will say something like, this company is growing, but they're spending more money than they're bringing in. So their thinking is that's never going to change. They have all this growth, but they're not profitable. So they're just immediately thinking not profitable means the model doesn't work.
My response to that would be, I think where people pull their context from is some of the horror stories of, direct-to-consumer companies in all sorts of different verticals that have such a high acquisition cost that they never have a formula of success. They never have, I spend $1 and I make $5. They spend $1 and make 75 cents. And they're always upside down. We've never really been upside down. And that would be my first point is, we've always been able to demonstrate we can spend $1 and make multiple dollars. And that's what's allowed us to grow, is our ability to actually self-fund in a lot of ways. And where we've made bigger investments, we're not looking real-time returns. So for example, we did the partnership with UFC. I don't remember when that was, let's say Q2. We didn't really start to feel a lot of that value kick in till probably Q4. And I would say 2025 is really where we're going to reap the rewards of that. So there's a delayed investment cycle with some of these bigger expenses, that I think need to be noted. The second thing that I would say in that same conversation would be, we don't have a lot of competitors. So we're not really outspending somebody else. And I would say where most of these other companies fall victim to is trying to outspend their competition. We aren't really outspending anybody. And that will, I would say, keep our ability to throttle, more freedom to throttle up and down, because I'm not trying to outspend some, other company. Do we have competitors? There's definitely people out there that claim to have, a product or solution, but from an actual viable solution that, has the transformative potential, not only just in the consumer category, but other categories, there really is nothing like, Aires in the market. So I'm not really paying much attention to competition in the same way I was if I was selling mattresses, right? And where the market has a lot of choice built into it. There isn't a lot of choice built into our market. So that does give us a lot more freedom. We've chosen to be aggressive, and sometimes that comes at a cost because you are growing at a really aggressive rate. However, we expect 2025, 2026, and the years to come where the efficiencies only widen. And these investments we made in our partnerships, this is why these investments were made. In addition to the fact that the majority of our partnerships knocked on our door. And so that's another proof point for us, was like, okay, how do we throw some gasoline on this? How do we accelerate this? Because we clearly have a lot of high profile partnership opportunities that are coming to us, wanting to learn more, wanting to know more, and wanting to help share our message. So when I look at 2025, 2026, and beyond, I only see efficiencies. I don't really see the same level of challenges that these other companies, where I think people pull their kind of mental models from, the mattress companies or the cycling companies or some of those other companies that I won't mention the names, but we all have these horror stories in our head where they had this upside down acquisition strategy. Number one, we're not upside down. And number two, our momentum is only building, which means the efficiencies should only improve. And all signals we have, all data points point to that thing happening, this efficiency engine increasing. So what we do in that period of time, do we reinvest, or do we take money off the table? And I think those are some of the strategic decisions that we'll have to make. But that's really how I would respond to that. And I think it's our duty to do the right thing for the future and not in the short term.
And if I might fit a little bit, that's exactly what the very last part of his answer is, that it really depends on your framework, how you look at this company. If you look at this company as a trend that's going to run for 2, 3, 5 years and then die out, then yeah, you really need to focus on profitability because your clock is ticking, time is running out. However, EMF is not going anywhere. The 5G, 6G, 7G, they all continue rolling out. We're never going to get rid of Wi-Fi. So the persistent issue is only going to get actually more concentrated over the years. So we don't really need to rush to get to the profitability today because it's not a trend we're building. We're building a brand like Coca-Cola, like Amazon, like Uber. They took their time positioning themselves, locking in their competitive advantage, and then enjoying the benefits of being the market leader and then making the profits in the years to come. And this is how Josh and I see this company as well. We're not seeing it as a short-term thing. So it's really important to understand where you're coming from and what kind of investment you want to make.